Yes, thank you very much, and thank you very much for the opportunity to come and talk today. I'm not really going to talk about Miton Group. We are a quoted company, a small fund management group with some hopefully interesting prospects. But what I wanted to talk about today was particularly the change, the radical change we foresee in institutional portfolios at the smallest end of the market. As we know, institutions are often heavily involved in the largest companies, but they're not often involved in the very smallest companies. And we see that radically changing. We see that the best performing sector is going to be the smallest companies, and if institutions don't get involved, then they will miss out badly. And it's what I want to talk today about, therefore, is the future is small, and about why that change is going to be coming through now. So to start with, I just wanted to kind of sort of go backwards and just say how the investment world has been for the last sort of 20, 25 years. Effectively, we've been in a very buoyant period. Growth has been very good in the UK. We had the longest period of uninterrupted growth in the UK up to 2008 ever. Even subsequently, growth has not been too bad. It's recovered more recently, particularly with the PPI payments. And so the investment climate has been very good. Just about everywhere has been making money. Some areas have been making more money than others, but investors have got very used to a kind of very verdant period where returns have been excellent and growth has been easy to find. The question is, why is that changing? Why are the headlines now becoming different? We're actually getting not just the oil price collapse, but a lot of world growth expectations have fallen back. And this is in spite of QE. This is in spite of super low interest rates. This is in spite of a period where governments have been running budget deficits much larger than they would normally expect. And so we're actually seeing a changing climate. And we can use an analogy potentially to give a clue as to how significant this is going to be. For those who are meteorologically minded, you may remember being back at school when you had these kind of dry periods which were just beyond mountain ranges. On the way up, you used to get quite verdant periods, but beyond the mountain ranges, somehow there's a lot less rain. And that's really all down to what's called rain shadows, where you get the clouds blowing in from the sea, full of rain. As they fall, there's plenty of growth on the sort of windward side of the hills. But as you move over the top of the hills, because the clouds have been forced up into the cold air and they've been the rain has been taken out of them, then you do find that actually on the other side of the hill, you find it's much drier. And I would argue that we've just been through the last 20, 25 years where we've been on the rainy side of the hill, and now we're in those drier conditions. The investment climate has changed. And to some extent, as the cool air comes down, the spent rain clouds actually produce much less rain. Effectively, rain shadows lie beyond mountain ranges, and I would argue that actually growth shadows lie beyond credit booms. This is debt as a percentage of GDP. This is looking at the US, but it could equally be the UK. It could be some of the Far Eastern markets. And what you can see is that between the 1940s and the 1980s, growth and debt grew together. And then, of course, debt was deregulated. And when it became deregulated, the opportunity for using debt was there. If you had more debt, you could buy up assets. Asset prices have screamed up for the last 25 years, not just bonds and equities, commodities, housing, property, vintage cars. Every asset class has been a terrific area to make capital gain. But, of course, that's taken people's eye off the ball. It's really just a case of trading in and out rather than getting involved in companies in the long term. But what you can see at the end of this chart is in spite of QE, in spite of record low interest rates, debt is now contracting. We have moved beyond the credit boom, and as we move beyond the credit boom, we've moved into this period of slower growth. And so we've got the challenge going forward of what do we do about slower growth environment. Well, going back to the plant analogy, if you look at some of those areas which are drier, you do find some small plants manage to exist in spite of the dry conditions. Indeed, you sometimes come across plants which are thriving in the most unpromising places. And so, in a way, if we use that analogy, you can look back to see that smaller companies have more growth potential than larger companies. Small plants have more growth potential than big plants. And so if you go back to 1955, you know that if you invest just in the main stock market, reinvesting that income, compounding over time, there is no cost associated in this particular exercise. But you can see the UK market delivered 1,000 times your money. But smaller companies, the bottom 10% by value, produced nearly 5,000 times your money. And the really good news is that that extra growth potential is proportional to size. The smaller the company, the better the performance. And that's why, as you move down into the bottom 2% of the market, then you get 21,000 times your money rather than 5,000 times your money. So with that, it's often the smallest which are the most vigorous. And that doesn't make any difference when the market's rallying hard, because there's lots of growth around the world. Small and big are both growing very rapidly. But at times when the world isn't growing, you can find that sometimes small can grow in the most unpromising areas, in the dry areas where perhaps we're now moving into. And if you go back looking, a lot of portfolios have got optimized for credit boom conditions. What we're going to find now is that beyond the credit boom, that the portfolio is going to have to be reorganized to include this unusual period of more challenging conditions, and that the portfolio is going to have to be different in the way that they're made up. And that is why we believe that actually it's a very good time to start really considering looking at the very smallest companies going forward. So you've got to say, well, that's all very interesting, but why should institutions do it? It's really a small part of their universe. They've got many big companies. They've got lots of very highly paid experts helping them identify the best big companies. What's going to cause them to change? And of course, what's going to cause them to change is that they're going to find that the investment returns they're generating on the larger companies are constrained. When world growth is slow, large companies struggle to grow. And that's the period we've entered now. And this is much more akin to the 1970s and 1960s, when the UK was actually known as the sick man of Europe. We had dysfunctional industrial government. We had stop-go economy. We had lots of other things going wrong at the same time. We had clearly lots of problems with our currency. In the 1970s, we actually had the IMF coming to rescue the UK because of our weak currency. We also had problems with oil price. In this case, it was an oil price shock when the oil price went up 4 times. And inflation went through the roof. Gearing, those companies with gearing were badly affected. Many companies went bust. Many small companies went bust. But the point was that big companies weren't able to produce a very commercial return. It may look good that between 1955 and 1988, the large market, the all share, produced 76 times your money. That may seem like quite a lot of return, but inflation averaged 13% per year for the entire 1970s. Inflation was right there, and your returns were being diluted by this rapid inflation. And so 76 times your money was not a very attractive return on your investments. But what is interesting, in spite of markets coming down, the market fell nearly 80% in the 1973 period. We also saw all sorts of uncertainties about changes in government, all sorts of political uncertainties and all the rest of it. Small companies, in spite of their liquidity, in spite of their smallness, because they could grow better than bigger companies, produced a better return. And you can see here on the red line, the smallest 10% by value, the numerous small companies index, produced 400 times your money. And coming back to those very tiny companies, the bottom 2% by the numerous 1,000, as it's known, produced 1,100 times your money. So for institutions, unless they have some smallness in their portfolio, they're not going to be able to produce a return which is commercially attractive. And so they're going to have to start to learn to move capital away from the very largest companies. They're not going to move completely away. They'll still have 85%, maybe 90% in the large companies. But that means they might have 10 or even 15%, not in small and medium-sized companies, but small and micro-cap companies. That is a radical shift which they're just not prepared for at all at the moment. And of course, being small at the bottom end, many of these small companies, when they get inflows of institutional money, will suddenly become very hard to buy, and share prices will start to move, and they could move considerably, in my view. There's a big catch-up trade, which is still to be had, and beyond that, then there's further capital to be allocated. And of course, it's not just about share prices, it's not just about earnings growth, it's the ability of smaller companies, micro-cap companies in many cases, to put cash to work to increase productive returns. So many large companies are on a capex holiday at the moment. They don't know what to do with all of their cash. They don't know how to make a return because there's not many big projects which are going to produce a return. But you'll hear today from many of the other small companies which have opportunities to invest 3, 5, 25 million in different projects on a 3 or 4 year cash payback, perhaps even less, maybe 2 years or even 1 year. And so that means if they put that 25 million to work, they will generate 25 million of cash in 3 or 4 years, or sometimes even quicker. So the advantages of small companies isn't just that they can grow faster, they've got more growth potential, but being quoted small companies, they can use the advantage of their quote to invest capital and use capex at a time when equity capital is scarce and get disproportional returns. And that will be paid back in dividends. Ultimately, what really drags up a share price more than anything else is the ability to grow dividends. And if you look back in the 70s and the 60s, small companies grew their dividends on average 2% per year faster than the larger companies. And that was the overwhelming factor which dragged institutions into the bottom end. It's not all theoretical, it's hard cash, it's the folding stuff. And that's what's going to drive the sector. Of course, that's not where we are now. For the last 25 years, growth has been plentiful. Institutions have learned to live without small companies. They spent the last 25 years coming out of the sector, selling small companies, because it didn't make any difference whether you were in big or small companies. Medium-sized companies certainly have outperformed, but generally small and big companies have actually acted pretty much the same. And so you've got a whole generation of fund managers who've come through and they've only known credit boom conditions. To them, this is normal. But of course, to the rest of us, we can see it in the context of the longer period. This is the abnormal period we're coming to the end of. We're going back to normality, the stop-go economies of that. And so the advantages of small companies will start to rise to the fore. Effectively, the world has changed. And because it's changed, so will portfolios. And what we'll see, effectively, is a great interest. At the moment, this is different bands of companies and the numbers of them. On the right-hand side, you can see the band of companies by number, which are over £1 billion in market capitalisation. And there's probably 230 or 240 of those. That's where all of that institutional effort really goes. There's a small amount of institutional effort which goes into the 300 to £1 billion companies. They are made just under 200 companies of that size. But pretty much below 300 million market cap, going into the 50 million pound companies, going into the 25 million pound companies, certainly going into the sub 25 million pound companies, institutional demand is very weak at the moment. And they're not really interested. It doesn't matter how cheap they are. It doesn't matter how good the investment criteria are. Many of them say, come back when you're bigger, we'll have a look. Because the world has changed, because economic growth is so difficult now, and because small companies are going to outperform, they won't be able to have that luxury going forward. In time, we'll find institutions moving into those 1,000 companies below 300 million market cap, which are the returns, where the returns are going to be best. And because the effect is proportional, smaller companies produce a better return. It's those companies at the very smallest end which will be producing the best return. And if you look at the very bottom of the AIM market, there are between 600 and 700 quoted companies below 25 million market cap, which we think are going to produce some of the very best returns. There'll be companies in there which go bust. There'll be companies in there which don't succeed. But there will also be companies which succeed in spades and deliver extraordinary returns. And so the opportunity is to move down that market cap range, and that's where the way we see investment capital going. So in a way, portfolios will change. It's about having a diverse range of individual stocks. It's no use just going for one or two. You may luck out and get fantastic returns on those, but you may be just unlucky that those particular companies don't win out. So do spread your investments across a wide range of different types of companies with make sure the correlation isn't all the same. They're not all just backing the same market. But we are in a period of extraordinary change, and because of that, if we recognise it, we can take advantage of it. And the opportunity today is to meet many of those companies. What we've done at Miton, in my small companies fund, is that we've put about 60 or 70% of our assets in the AIM market. Now, since we set this fund up in 2012, the AIM market is up just 0.3%. Very, very poor returns. Many of the companies which are involved in mining or oil and gas have had negative returns, partly because of the oil price coming down. And we've also put most of our capital in the companies under 250 million, and particularly sub 100 million market cap. That's where we see the best of the opportunities. There's plenty of companies for you to see today. This is our largest 20 holdings. I wasn't going to pick out any particular one today because I thought it'd be unfair to pick them out. But in our examples of the kind of holdings we have include Conigar. We're not very keen on property companies generally because they have too much debt for us. But Conigar is standing at a discount to assets. It's building a lot of houses on 3 new marinas, which it's putting up in Wales. And that's the kind of thing which just shows that even after the market's rallied, even after QE has driven cash into not just the bond market, but the equity market, particularly high-yielding stocks, particularly into some of the other areas, we're finding that actually there's still disgustingly cheap stocks to be found at the bottom end of the market. And in the technology sector, a company which we hold is K3 Business Systems, which is involved in providing systems for companies which are retail companies which are dealing with logistics issues. They've done it on a new Microsoft program called Axis, and this Microsoft Dynamics Axis platform is very popular at the moment, and they can't keep up with demand. And that's another company which we think is good. Again, tiny company, only 70 million market cap, but so interesting to Microsoft that Microsoft are taking the selling of this product on themselves in the US, because clearly this is a UK company, and they're doing it because they can sell lots of it in the States. So that's the opportunities as we see them. So the performance of the fund, I mean, as I say, AIM is only up 0.3, and it comes in steps. But you can make proper returns at this end of the market through a portfolio, a well-diversified portfolio. This has about 100 portfolio holdings. So you can make very big returns even with a well-diversified portfolio. So in conclusion, what we see here is that we've been in a period where the credit boom has led to rampant returns, extraordinary capital gains, a market which has become hugely transactional. But the opportunity is that that the world's changing. Many of those ETFs and other factors which have done very well for many years are coming to an end, and we can saw with the oil price, things can go into reverse, and when they go into reverse, in absolute terms, they can come down a long way. Therefore, we see that we're entering a period of growth shadow. The world may not grow very fast for many years. It took us 25 years to get into this crisis. It's going to take us a couple of decades to get out. It's going to take a couple of decades for those institutions to learn to love small companies again, as they did in the 70s and the 60s, when they used to have 15, maybe 10 or 15% of their total UK weighting in small micro, not small mid, small micro. The advantages of being smaller are going to come to the fore. As I say, it's not just the fact that they're more nimble. It's not just the fact that these are companies which are able to grow a little faster because they've got more growth potential, but most particularly because they have the ability of a quote to raise capital and invest at a time when others can't, to invest in assets which produce a commercial return, but most particularly to become more productive. It's the fact that they become more productive which ultimately will be the payback. That is the basis of all wealth creation. And large companies are really struggling to find good CapEx projects at the moment. And we anticipate that this cycle will be a super cycle. What we mean by that, it's going to last decades. It's not just about a year or two. Going back to the 50s, the 60s, and the 70s, and into the 80s, that was a cycle which lasted 30 years. We think this kind of cycle could easily last that kind of period. And that is why we consider the future is small. Thank you very much indeed.